A mathematical rule controlling $50 trillion of institutional money. In March 2020, Wall Street did not crash because of a virus. It crashed because of an Excel formula. Institutional traders were trapped in a mathematical prison called value at risk. When volatility explodes, this formula orders them to sell everything, no matter the price. It is a robotic rule called forced deleveraging. You bought the dip because you had no rules. They sold because they had no choice. This is why the smart money looked so dumb in 2020. They were not panicking, they were just following the rulebook. And if you want to know why this is a time bomb for the next crash, in March 2020, retail investors were screaming, panic in the streets. But on the institutional trading floor, silence. There was a trader managing hundreds of millions, sell everything comes eyes, turn off his screen and order lunch, as if it was nothing unusual. He didn't sell because he was scared, he didn't sell because he predicted the virus, he sold because a single Excel formula ordered him to. Most people think markets crashed because of COVID. That's wrong. Markets crashed because of this simple formula, a mathematical rule controlling $50 trillion of institutional money. Today, I'm going to show you that formula. I'll explain why retail accidentally beat Wall Street in 2020, but more importantly, I'll show you why that victory planted a dangerous time bomb in your brain, one that will wipe you out in the next crash. Quick disclaimer, this is education, no financial advice. So, look at this chart closely. These are retail investor flows in France. Throughout 2019, complete boredom. The bars are tiny or even negative. People were selling or doing nothing. But then comes March 2020, the crash. But instead of selling, buying volume exploded. In a single week, the worst week of the crash, retail investors pumped over 1 billion euros net into the market. This isn't just dump money panicking, this is an army of buyers. Now, quick clarification. You might remember that most retail investors freeze during a crash, and this is still true, this is still valid. But in 2020, something new happened. The new broker generation happened. And they did something historically insane. While the S&P crashed over 30%, this new wave didn't freeze. They bought and bought and bought even more. In France alone, 1 billion euro in the worst week. 1 billion euro during the crash. Now, the professionals, the smart money, well, Bank of America's survey said the institutional cash level was around 5.9%. That's like the highest since 9/11. Let's be honest here. In 2020, dump money acted like heroes. They bought the blood. The smart money, they sold, they hesitated, they went to cash. If you bought March 2020, by August you felt like a genius, doubled your money, while the pros sat on the sideline. And if you're watching this channel, you probably want to understand why. So hit subscribe, let's decode it. Because here's the danger. Retail didn't win because of skill. They win because of breaking the rules. And the pros, they didn't lose because they were scared. They lost because they were in a mathematical prison. To understand institutions, you need one concept: the risk budget. You have a budget for money, right? The Ferrari costs like 300,000, you have 50, you can't buy it. Simple. Institutions, they have a budget for risk. And risk has a price. That price is volatility. When a market is calm, risk is cheap. They buy lots of stocks, they buy lots of positions. Well, they stay in budget. When a market panics, risk gets expensive, really expensive. Look at this. The VIX, the fear index. March 2020, it hit over 80. 82 to be exact. That's higher than 28, higher than the financial crisis. Think about that for a second. Risk became 5 times more expensive overnight. The pension fund, the bank portfolio, suddenly couldn't afford the stocks. Not because Apple became bad, not because they hated Microsoft, but because their risk budget was blown. This is value at risk. The formula I mentioned. When volatility explodes, the formula orders you to reduce position. That's not a suggestion, it's a rule, often a regulatory rule. The trader that doesn't sell, well, he risks his career, so he sells into the crash at the worst price because math forced him to. We call this forced deleveraging. It's mechanical, robotic, like a robot vacuum hitting a wall, except with billions of euros. That's why institutions look stupid. In March 2020, they were forced sellers. The neo-broker clients, the generation of private investors, well, they had no risk management, no value at risk, no regulations, just a smartphone and a buy button. And maybe some stimulus money burning a hole in your pocket. So, retail won. Point for the little guy, right? Well, they won because the Fed printed over $3 trillion. $3 trillion. They won because of stimulus checks. They won because they were bored at home, in the middle of a COVID where there was nothing to do except buying shares and playing casino. So the people treated the market like a casino. This taught a generation of investors the wrong lesson. Risk doesn't matter. Stocks always bounce back immediately. No risk management is actually an advantage. But imagine 2026. Inflation high again. Fed can't print anymore. The market crashes. VIX hits 50. Institutions? They follow their models. Sell, take small losses, preserve capital, live to fight for another day. You, or the new generation of investors, if you learned from 2020, you buy the dip. It dips more. You buy again. It keeps dipping. Now what? No Fed rescue, no V-shape, just a 50% loss. That takes 15 years to recover, like 1929 or 2000. Institutions are built for survival. Retail 2020 built on gambling. And the house always wins. Remember these words. If you want to buy into a falling knife, at least don't leverage your position. Really, trust me, never use leverage on a high-risk trade. So, never buy dips? No, but do it like a pro, not like a gambler. You need your own risk budget. Here's my 5-second rule before touching any falling market. Before clicking buy, check one number, the VIX. Is the VIX above 30, above 40? Well, now you know. Institutions are forced sellers. They're dumping blindly, like robots. Why fight that? Why stand in front of the train? It's like trying to catch a piano falling from the 10th floor. Sure, you might catch it, but you know what happens next. So wait. Wait for the VIX to stabilize. Wait for it to fall. That's your signal. Forced selling is over. Smart money looks at fundamentals again. In 2020, buying blindly worked. But hope isn't a strategy. The Fed will save me isn't risk management. Want generational wealth? Stop relying on luck. Start respecting math. Boring is beautiful and boring is profitable. Well, in math is pretty boring to most people, which makes it perfect. Now you understand the mechanism. Prices aren't always about value. Sometimes just liquidity, just forced selling. But there's another mechanism, a darker one, not about survival, about profit. Ever place a stop loss, thinking you're safe? Then the market dips exactly at your price and goes back? That wasn't bad luck. That was a liquidity grab. In the next video, I'll show you exactly how we see your stop losses on the order book, when your safety net is actually a target for institutional algorithm. Watch the next video in the series. Subscribe if you want to stop being the dump money. I'll see you there.